Good morning, ladies and gentlemen. Well, I manually calculate that the risk dial is around -5 still, even though we had a bit of a better week. I don't think that the risk dial is showing any positive divergence. I don't think things are getting better. In fact, in many ways, things are getting worse. And I think this is a good opportunity to actually go back and have a look at historical periods where the yield curve and the bonds have been doing what they're doing at the moment, and give ourselves an idea of how far back we have to look at and what periods we have to look at for similarities and what might happen to equities eventually. Well, the 2s10s have finally gone negative. They've been threatening that kind of a move for a long time. This is now a weekly chart. And what can we do? We can go to a monthly chart and just see how quickly this has happened. Basically, we've had 1, 2, 3, 4, 5, 6. This is the 7th month of falls from, basically 130. And however far back we go, we can go back as far back as this chart allows, which is basically all the way to the great financial crisis 2011 or so. This is basically the lowest it's ever been. And what does that say? Well, 2s10s, I don't think it says very much, because I think the recession comes when this starts steepening. But if we look at 5s30s, which we'll look at next, that is a very interesting chart, and we will see where we are in comparison to other times in history. I think that 5s30s are a far more important part of the yield curve than 2s10s. And here we are, for the first time in a long, long time, we have actually gone negative. We are through zero. This is zero, and this is now where we are at, just over 1 basis point of negative. Let's go back in time and look at this line. So basically, we are where we were, exactly where we were back in 2006. And as you can see, we just basically went sideways throughout 2006. And then in 2007, we started steepening a hell of a lot. And this is what, when the accident took place. So the accidents take place when the curve starts steepening again. But let's go back in time, and here we are at 00, when we got to negative, what is this? Negative 40 ticks and negative, let's call it 55. So in 99, the yield curve started going negative, and it went to its most negative. It'd been around 50 odd basis points. And then the accident happened in 2000, from 2000 out to 2002. And that's when the accident happened in the equities. And now we can start going even further back in time. And as you can see, we are back now in 1989, and that is when the accident started happening in the early part of the 90s. And let's go back all the way back to 81, 82. I mean, this is the only bit I don't remember. We went negative 112 first, and then 150 basis points of negative yield. And this is basically the Volcker period, when we went to 110 negative and very, very quickly went to 80 positive, back to negative, back to positive. So what can we say? We can say that the yield curve is saying that we are in periods like 2006, 2007, 2000, 2001, 1989 to 1990, and back to 1980, 1981, 1982. Those were not the most stable periods for any asset class, let alone bonds, let alone equities. Everything was going crazy. So history tells us that things are going to go very crazy. The yield curve is not wrong for long. The yield curve is the best predictor of just about everything, and it's telling us that we are going back to periods that have not been seen for a long, long time, that 99% of traders who are out there at the moment have never seen in their lives. And even this, I haven't seen. I started trading here when it was flat. So it really could be, I think the moves now are going to be highly unusual, highly convex, and basically people won't know what to do, and they'll be stopped every which way. This is now a chart of 10s, 30s, a weekly chart of 1030s, and here we are at flat, okay? So this line is flat, and it shows exactly the same as 5s, 30s. And the 10s, 30s is a particularly important part of the curve because it basically tells you how to price long-term assets, long duration assets like equities. And here we have the same thing. This is 2006, 2007. We are very much where we are now. This is exactly where we are now. So we are in a similar period, the yield curve says, and this is how far negative it got. 10 basis points in 2000. That's where it was, oscillating between 0 and 10 basis points, basically flat. So it's showing absolutely exactly the same thing as we are seeing now. And this is back in where we had the accidents in the late 80s. And basically it was between flat and say 20 basis points positive. So we are within 20 basis points of as bad as it got. And then this is now Volcker. This is as bad as it got, basically 80 basis points in terms of positive, and then very, very quickly to minus 20. You can see basically that the 10s, 30s is telling you the same story as the 5s, 30s. I'm not surprised that it's telling you the same story, but it's telling you how far it can go and how quickly it can go to say 80 basis points negative. This all tells me that the Fed is in a real bind, and it really has to really start accelerating the hikes. Otherwise, this yield curve, I really wouldn't be surprised if it started going to the same levels as we had in the late 70s, when it got to 40 basis points positive, and now we're at 0. I showed you those yield curve charts going back 50 years because I don't want you to be surprised by big moves at the shorter end. How does that yield curve do what it did, and what it can possibly do again? And that is by very, very big, much bigger moves. And I mean by a factor of X at the shorter end. This is the 5-year weekly yield. So I really don't want you to be surprised if this moves a hell of a lot, 3 times as fast as the shorter end. Sorry, it's 3 times as fast as the longer end, i.e. as the bonds. So moves that bring it down to 235 or even 213 and then very quickly take it above 3 should not surprise you. This is what the market basically is saying with those potential yield curve moves, is that you could see complete carnage at the shorter end of the yield curves. So my expectation, as you can see here last week, this is a weekly chart, we basically closed unchanged in terms of yield on the 5-year through the Bollinger Bands. But so quick moves down and then even quicker moves up should really not surprise you. And really, even getting to 3% should really not surprise you over the course of the next few weeks. I don't think April is the time to do it, but I think after that, after the Fed has set the course, you could see, and we have the meeting in early May, you could see some really surprisingly big moves. Now, this has been a big move, and this probably needs to be digested over the course of the next few weeks. But after the digestion, I think you can have some much greater volatility. I think much the same thing is likely to happen in the 10s and 30s. I would not be surprised by a nice move down into this area, much as we saw here, and then a big move up. You have to realize that these targets from these ABC retracements are all around 3%. And if we change this now to a 30-year chart, and this is now the 30, that is indicating also 3% and above. Now, if we do go to negative, a negative yield curve between 10s and 30s, which can be -40, -50, that would indicate that the 10-year note can go well over 3%. What I'm saying is that I don't think the volatility in rates is over, and I don't think it's going to get much better anytime soon. I think the 30 years is going to be the one which has the least volatility. But I still think that the odds are that after a certain period of time, you get moves up to 3%. And that wouldn't be the end of the world, sort of anywhere between 294 and 332 would really not be the end of the world as far as 30 years are concerned. After all, they came from 3.5%. So going back there is not going to be surprising. What will be surprising is how high the short end can go to cause a recession. It can, 5 years, and I can put that back. If the yield curve is correct, the 5-year can easily go way above 3%, and we're talking about 3.5 to 4%, and that is what's going to cause the recession. If that, all I'm really saying is do not be surprised by enormous moves in the shorter end, which naturally influence the longer end. And what I'm saying is actually mirrored exactly in Europe. Now, this is a 2-year in Germany, monthly chart. And really, we have taken out this whole range here. And I really would not be surprised, by this level, i.e. 35 basis points. And would I even be surprised by us trading here, which is 130 basis points? Not really. Give it enough time, I think that is where we're going. So that's a 130 basis point move from, 140 basis point move from where we are. And people already think that we are at some extreme. I've had to go back to a monthly chart because I can't show it to you in any other time frame. Why would it be surprising if in this period of high inflation we went to 130 basis points. Why? This is exactly where we were in 2010 and 2011 when inflation was zero. So why be surprised? So if we swap that now for a 5-year, this is the bubble, why would it be surprising if we start trading here, which is 79 basis points, i.e. another 40 basis points? And if we go to the 10-year on a monthly chart, why would it be surprising if we start trading here? This kind of area, which is 140 basis points, which is another 100 basis points or just short of from where we are at the moment. I really don't think that you should be surprised, and that is the mirror that somehow fits in with what the US is doing that I showed you. I'm telling you, do not be surprised by absolutely huge moves in the bond markets, and those moves are going to have eventually corresponding moves in equities. I don't think it's an accident that the yield curve only mirrors periods like 2006 and 2000 and the late 1989s, early 90s, and then back to 79, 81, 82. That can't be an accident, and these chart patterns can't be accidents either. Now, don't forget that these are monthly patterns, so could we have 3-4 months sideways? Absolutely. But I think the path of least resistance is set. This is more or less where we are going. I just am pretty convinced of it. Now, this is a chart of the clearest chart, the one that technically trades best to me. And this is the OAT, the French market. Well, if you draw some kind of a trend line down, you can see that we are out of it. Now, do we repeat this pattern here for a bit, 2-3 months of sideways, and then we break? But when we break, this is where we're going. We're going to 240 basis points, okay? And now we are at 1. So every chart that I look at says this is a period that eventually could provide massive upside volatility. The differential between US and Germany is basically 182 basis points, what you want to do at the end of the day. It keeps on trading, spiking up and coming back. It's getting, basically it's saying that it's in this range between, low 190s and low 160s. 30 basis points range, and it comes back into the middle of 182. I still think that eventually, you cannot say that inflation is going to hit the US or it's going to hit another part of the geographical world, because inflation is inflation, and if commodity prices are traded on a worldwide basis, so it could be a little bit less in one area, a little bit more in another, but eventually inflation is inflation, and it's going to hit all parts of the world. And that is why I'm not surprised that this is not moving very far. But eventually I would have thought that the ECB is the one that has to catch up with its policy to the Fed. I think the Fed is going to be more proactive and quicker, but eventually I think it's going to be the ECB that has to catch up. And that is why I think that those charts that I just showed you of how far Europe could go would indicate to me that this spread at some stage is actually going to break down and trend towards zero. And maybe not zero exactly, but towards less differential between the two markets. And that to me indicates that the potential is there for very, very big moves in the bunds and the bobbles, probably bigger than what you're going to get in the US. In the dollar, another week of sideways, basically. We've gone, I can enlarge this part, and what have we done? We've closed down from where we closed previous week in 98.80, and we closed this week 98.50. So really, it's another week of sideways in a range, and you can see that the range is basically 97.70 to 99.35. But to me, the path of least resistance is still up towards 99.83 and 139. The interest rate differential is basically going up and down in a 30 basis point range, and that is reflected in the DXY. That no change to me in, sort of look at it. It's basically, I still expect it to break upwards. I think it's going to go sideways for another 2-3 weeks, and people are going to start saying, well, when the Fed hikes, that's when DXY is going to break down. I just don't think so. I think that the lag between ECB and the Fed is long enough at the moment to keep DXY up here. When will DXY start breaking down and staying down? Well, that is when we feel, or the market starts anticipating that the ECB is going to start catching up. I think that at the moment the process is still one of moving away in terms of the Fed is going to do things much faster than anyone can even anticipate the ECB doing. But at some stage in a few weeks' time or months' time, that process is going to be reversed. People will start anticipating that the Fed is going to come towards the end of its process, while the ECB will be at the beginning of its process of tightening, and that is probably when DXY can start moving down towards these 95 areas. But it's going to take, I think, many, many more weeks. And that is why I just think it's far too early to sell and go away. Maybe if we start reaching above 100, that could be the time. But I think it's going to take quite a bit more time for that sort of thing to happen. I just can't get bullish of gold. And that is because I keep on looking at the dollar, and I keep on looking at rates, and I keep on seeing that the danger is all to the upside in those two. And therefore, how can I just go limit long of gold and walk away from the position? I just can't. Can gold go sideways here for an extended period of time? Yes. But would I be surprised by gold coming back down? And let's do this on a daily chart. Can I be surprised if rates start going up and we actually come back down towards the 200-day moving average, which is at 1830? Basically, we are going sideways between 1960, call it, and 1880, 1881, and I can see that continuing into the Fed, but eventually I'm afraid that gold is going to break down. Anyone who remembers how gold traded back in the late 70s, early 80s, when the Fed pushed the economy into recession by hiking rates, gold collapsed. It went, from memory, about 30%. It got up to into the 800s and then fell, way lower. and kept on going lower. So I just can't get enthusiastic about it unless there is some kind of development in the war and things get much worse. I really find it hard to see it breaking up above 1955. You would have to have some pretty, pretty important developments in that war for that to happen, or for the dollar to reverse, or for yields to reverse. But all those need reasons. And unless I can see a reason why that is happening, I just can't get bullish of gold. And I think it's going to remain in this range. As you can see, it basically is in the same range as it's been since late last year. The middle of last year. And I don't see that changing, with the possibility actually that if we get some sort of signals from the Fed that it's going to accelerate hikes, and that we get that kind of acceleration of the negative yield curve with 5 years going above 3%, I think gold then is something to avoid. Oil is at a very interesting juncture. I actually trade oil very, very rarely, but I'm thinking of going short at some stage, simply because if my not prediction, but my fear that rates at the short end can go much higher, and at some stage that brings in a recession, the demand destruction you will see in oil is going to be something to behold. It's going to basically come back down to 75 and even back down to 40. The yield curve, I don't think lies, and that is what the yield curve is basically saying, that we are in periods like 2000 and 2005 and so on. So what happened in 2000? In 2000 we went from whatever it was, 33 down to 18, so 50%. Then in late 2007, after the squeeze, we went from 140 down to 40. We are likely to get, especially because everyone is bullish again, we are likely to get that kind of a move again, 30-40% at least. It's a distinct possibility, and really what one has to think about is this chart here. If one is not bullish of gold and thinks gold is going sideways, and we are at very interesting levels in gold DBC, i.e. favoring gold over DBC, well, how is that going to be achieved? And the most logical way to look at it is that DBC is going to get killed, and DBC is mostly oil. I.e. it's going to get killed while gold gets killed much, much less. And we go back to these kind of levels, okay, to let's call it 100, and that is a 30% move. That is the kind of times that we are in. And it all depends on what the bond market is going to do. And basically the yield curve is predicting that the bond market is going to do very, very big things. So take it with a pinch of salt if you want, but that is what the bond market is saying. And if we then look at what DBC has done, well, would it really be surprising if DBC over the course of the next 2 years traded back down to 18 from these levels that we are seeing? No, not really. I mean, this is we can do this, right? We can just say, what would it take for a 50% retracement of the move? Well, the 50% retracement of the move is 19. Okay, so it's nothing big. So what I'm trying to say to you is that all these markets are actually beginning to align and say that if the bonds do what I told you at the beginning they could do, this is what they are going to do. DBC is going to come down to 1940. Oil is going to come down into the 65-70 area. Gold is going to come down into the 1800, 1700, 1800 area, much less than all these markets. But these are what the lessons from history are. Because if the bond market, say the 5-year note goes to 3.5%, while the 30s are at 3%, the demand destruction is going to be absolutely enormous. And DBC, really, I would not be surprised to see it down here around the 19 area. If we look at what the Blue Angels are saying, the valuations, the expectations of forward earnings are still going up. And basically we're trading between 18 and times 20. Last week we were rightly, I was rightly bearish at 44.20, which is basically times 20. The market came off a bit. What is the market likely to do? Well, I think since the April seasonality is the highest of the year, it's probably likely to go sideways. Unless and until the bonds start doing their thing. And as I think I showed you, there's a very distinct possibility that over the next 3 weeks, the bonds just basically stabilize, do not a lot, and then at some stage they just go parabolic. Now this is beginning to, and if you look at what the yield curve is saying, and you go back to the periods in which it was saying what it is saying now, you are looking basically here at 2007, and you can see this similar period where the Blue Angels were just refusing to come down. And I remember throughout 2007 being as bearish as hell and continuing being more or less stopped out and the market returning. I don't know if I can enlarge this even more. I probably can't. And the market then returning to the levels until the Blue Angels started flattening out. Well, this is what we have to wait for before we get bearish of the stock market. I don't think the stock market is going to go down until the forward earnings start flattening out. Until then, we're going to keep on doing little wedges up towards the times 20. And as this goes higher, the market will go overall higher for the next few weeks, but eventually it will go back down to the times 18 because there will be a growth scare. My narrative is not changed. The housing market and the XLY are the things that you have to look at. The consumer cannot take these increases, and especially if they start accelerating increases in yields. The housing market and consumption are really, really tied together. The fact that they're both still in a spurt, in an ending spurt, is what is preventing this market going down, going lower. But I'm pretty convinced it's going to happen at some stage. Housing data and spreads of XLY against other things is what I keep on looking at. And until those start turning positive, I can't believe that we're going to make new highs in the stock market. I think that at some stage, basically you wait for it to get to times 20 and then you play again on the bearish side, but without assuming that it's going to go too far in the short term. And this is basically the chart of seasonality, with April as, by far the best month, even better than November and December. And that is why I find it difficult to see that the market is going to get absolutely killed, because the seasonality is positive. You can see the worst was actually 9%, but that's neither here nor there. I'm sure there was a reason behind this, whatever it was. And I can't see the reason now. We all know that employment is strong and inflation is high. We know there's a war on, unless things get much worse with that war, and unless commodity prices as a result of that start going berserk again. I think we all know that the Fed on the 4th is most probably going to do 50 basis points. So we're not going to start speculating on 75, I don't think. I think that's very, very unlikely. And therefore, this figure of seasonality is unlikely to be this. It's more likely to be, well, not that either, but it's more likely to be towards the average, which is a positive average. Don't forget, 1.7% is only 60 ticks. So, call it 70 ticks. So, and we've had that in 2 days. So all I'm really saying is that we are likely to go back to, 46, 30, and back down to 4,500. So, and then back up to 46, 30, 40, 50. So that is really all that says, but it just says that don't expect it to go down hard. These spread charts are still what I'm looking at, and this is equal weight consumer over equal weight discretionary, and it just still is very bearish, this chart. It just says that the staples are gaining ground on the discretionary, and you can see that we are basically at the same level, more or less, that we were when when COVID arrived. And here on the SPY over XLY, we are also, at not very far from levels where COVID happened. And both charts are saying that the discretionary part of spending is in danger, right? So if we start going up in SPY over XLY, it's going to be it's not going to look good, and that is why I really can't get positive for new highs in SPY. I can get positive for 100 ticks, but I can't get much more positive than that. I want to also delve into something which has been puzzling me for a while, and this is the chart of JPM, of JP Morgan. This is a weekly chart, and basically $140, let's call it, that is where the previous peak was, and then we had COVID, and then I just went berserk buying in here, and here we are, we went above it, and now we're back below it. Why would JPM be going down? It's not because of the current shape of the yield curve, because that is actually positive for banks. The fact that there is such a big spread between 5 years and the overnight rate is actually positive for funding spreads. So it must be to do with predicting some kind of recession, and or the predicting which is really the same thing, which is predicting what credit is doing, i.e. the quality of the balance sheet. and they tend to go very much hand in hand, the quality of the balance sheet and the recession, because why would someone not pay you back? Well, because the economy is doing very badly. So it's a tautology, really. But that is what the best bank by far in the US is doing. And that puzzles me, okay? That puzzles me because of this next chart. And this is this next chart, which basically in blue you have the steepness of the yield curve between overnight and 5 years. Not overnight, but 2 months, something like that. And XLF. And as you can see, when the yield curve goes steeper, you get these movements. So what is this predicting? The fact that XLF is staying in a range and not following this tells me that this part of the yield curve is about to really turn. Okay, so basically what it's saying to me is that the moves up in the short rates are going to be brutal, and that the yield curve is going to flip negative even at the front part of it, i.e. you will have a negative yield curve. But that can only happen, if you think about it logically, if Fed funds go a lot higher than 2.5%. And this is basically what, the XLF and JPM not being able to keep up and go higher. I mean, I'd expect XLF not to be down here, but to be up here. And that's quite a big difference. And if it can't, then it's predicting that this part of the yield curve is going to come back down a long way, and then XLF will follow it. So it fits in with what the yield curve in the 5s 30s and the 10s 30s is saying, that you're going to have some massive moves in rates, especially at the shorter ends, and you saw what I showed you in Europe. So, but this is all longer term. But this is what these charts are telling me, that we are getting towards very scary times. Not in the next week, not in the next month, but after that. So if we look at the cleanest chart that I have with the levels, and we enlarge this area, to me it's quite significant that we closed back above 45.37. Could we go and retest the highs here? Absolutely. 46, not a problem. I think this market is only going to have a problem if it closes below these levels. I think we are more likely to go sideways and get overbought over the next few weeks. Next few days, actually weeks. And then we're going to have another move down. I think it's far more likely that the market gives you the old clear, yes, yeah, let's go for all-time highs, blah, 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 and then just falls apart. I'm not going to be bearish over the next few days until and unless we see this 46 level, and then we can rinse and repeat what we did up here in terms of option plays. So for the next few days in NQ, I actually think that, you see, we have a gap here to this kind of level, which you can see how significant it is, 15,600. We very beautifully turned off the 15,100 level that I thought we would. And what does that basically say? I would love to see this gap filled up here, with NQ leading and ES not getting much higher than that, 40 area, 46.40-ish. NQ goes up, ES doesn't, a bit of a divergence and back down. That kind of thing, that is what I'm looking for next week. I think, this 15,700 level is going to be very important, and, buying some option spreads when it's filling this gap, and looking for, I don't know, 15,500, 14,500 put spreads for 2-3 weeks. I think that is going to be a decent play, just, emulating the play that we did last week with ES. The other markets basically are saying the same thing. They keep on failing at important levels like 28,335 in the Nikkei. I wouldn't be surprised by a retest and a little bit more and then back down. Just like here in the weeklies, I would not be surprised if we got people long at these levels and then came back down towards 27,000. And just like in Europe, I wouldn't be surprised to see 39.86 and then another move lower. And just like in DAX, I wouldn't be surprised to see a move back up to 15,000 and then back down to 14,000. These are it's all echoing and mirroring that we're going to have a couple of decent weeks. Don't forget, basically the market is going to be in a holding pattern overall until the Fed, or it's not going to want to move a million miles. But I think the path of least resistance for the next week or so, or even 3 weeks, because of the seasonality of April, is going to test some kind of a higher level. And EM is doing much the same thing. I think EM can easily trade to this 47.93 or 47.52 level. Okay, we've got the key reversal, and this is the level that I'm going to let mine go at. You can see how important this 47.93 level, call it 48, whatever you like to call it, but that level is, to me, going to be where I let go the stuff that I bought down here. Volatility is doing what volatility does and exactly what I expected it to do. And basically it's coming down to these levels around 1750. It's going to be, another couple of weeks or something like that. It normally does it for 3-4 weeks, and that is why I think it's likely to remain, the market is likely to remain roughly bid for another 2 or 3 weeks. And then I expect another move higher. If we look at, don't forget that there is still this gap to 35, and I bet you over the course of the next, I don't know, let's call it 2 months, it gets filled. So there will be an accident in equities at some stage, just not now, and probably not for a few weeks. I still expect volatility to trade down. I'd love to see 3 or 4 days of huge calm, just, mirroring these periods that you can see, somewhere around in the 17s, 3 or 4 days of nothing. And that means that people are getting long, all at the wrong level. That is what I'm hoping to see, to actually start buying some options. And onto the bias table. I've updated all the levels. I really think that you don't want to trade the yield curve. The only way I would trade the yield curve is via options in the underlyings. Long of put spreads in the 5s and short put spreads in the 30s, something like that, if you want to do it. But we can discuss it on an individual basis. All the other levels are updated. Bund, Bobble, AOT, OAT, sorry, just scary. I mean, look at those monthly charts. Is it going to happen in next week? No. Is it going to happen in the next month? Probably not. But eventually, I just wanted to show you how far it can go. and why you should be very wary of getting long of those markets at any stage unless you're doing it for a very quick trade. All the big moves are going to be up in yield and down in price in the futures, we have to be looking for levels to buy longer term options, looking for very, very big moves in Europe. I've updated the levels here. I think the NQ can get up to the 15.5 area, but from there it's going to be a very, very interesting short. Thank you very much indeed, and tweet you on Monday.